This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you by...
Sailing through the heart of historic cities and landscapes on a river, you get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
Call it the Ballmer bounce. The CEO of Microsoft gives notice, and the stock surges on his surprising retirement announcement. Will the end of the Ballmer era usher in big changes at the company?
Cracked foundation. Sales of new homes plunge, the steepest drop in 3 years. Are rising mortgage rates scaring away home buyers and starting to pinch a key engine of the recovery, housing?
And the day after, the NASDAQ CEO responds to yesterday's shutdown. But individual investors are still confused and infuriated. How shaken is their trust in the system? All that and more tonight on Nightly Business Report for this Friday, August the 23rd.
Good evening, everyone. I'm Susie Garib along with Bill Griffith. Tyler's off tonight. Nice to have you here,
Good to
Bill.
be here.
Topping our news, a shocker today from Microsoft. Steve Ballmer is stepping down as CEO over the next year, sooner than expected, and there's no obvious successor to take over the top spot. On Wall Street, where Microsoft shares have languished for years, that was welcome news for investors. Shares of the software giant soaring right from the opening bell before ending the session up about 8%. Since its start back in 1975, Microsoft has had only two CEOs. Bill Gates built the company from scratch, and then he handed it over to Ballmer in 2000. So who will be Microsoft's new leader, and what's next for the stock? Those are the key questions for this iconic technology titan. John Fort has some answers.
How much do you think this advanced operating?
He's been Microsoft's biggest salesman and cheerleader. Now he's on his way out. The company announced today that within 12 months, it will name Ballmer's successor. Ballmer built up the enterprise side of Microsoft, fortified Xbox, and defended Office. Since he took over the CEO seat in 2000, the stock is down almost 40%, but revenue and profit are significantly higher. Along the way, though, Microsoft fell behind in huge categories like music players, smartphones, and tablets.
All CEOs have the same job. I don't have a different economic situation to deal with than the guys who run our competitors. So in a sense, you could say, whatever happens to the economy happens. We've got to win with great product, great brand, great innovation.
Ballmer didn't win in all those categories and clearly underestimated how big they would become. That's especially true of the iPhone.
He essentially treated it like a toy, a flash in the pan, and did not do anything, even though Microsoft was already in the phone software business, did not do anything to really change their trajectory till much, much later, and in a way, I think, too late.
Ballmer had told people internally at Microsoft he planned to stay until around the time his youngest son finishes high school. That's about 3 years from now. In a statement today, he said the company needs a new leader who can be there for the duration of its current transition from a software company to a devices and services company. So who will get the job? Anyone's guess. Internal candidates could include engineering head Satya Nadella, Terry Myerson, or Key Lu. External choices, well, maybe someone like ex-Apple exec Scott Forstall or former Microsoft execs Ray Ozzie and Stephen Elop. Whoever the board picks will face high expectations. For Nightly Business Report, I'm John Fort.
Well, on Wall Street, Microsoft was the biggest gainer in the blue chip average today, while the NASDAQ got a lift from shares of all companies, Facebook, which closed above $40 a share for the first time ever. That helped stocks end the day higher after shaking off early losses on disappointing new home sales data, but still closed lower for the third week in a row overall. The Dow today did close 46 points higher and settled back above the 15,000 mark. The NASDAQ added 19. The S&P was up 6 points.
Well, as Bill just mentioned, the drop in new home sales was much bigger than analysts and economists had expected. They plunged 13.5% in July, the biggest decline in more than 3 years. In the markets, that meant home builder stocks suffered some big losses, with names like Ryland, KB Home, Toll Brothers, and others tumbling. Until now, the booming housing sector was held up as a strong sign that the U.S. economy was on the mend. Hampton Pearson has more on what may be behind the sudden decline.
July new home sales may turn out to be a litmus test for what higher interest rates can do to the housing recovery. Sales were down double digits to 394,000 seasonally adjusted annual rate, the slowest pace in 9 months. June also saw a downward revision to 455,000 from 497,000. That's according to the Commerce Department.
We've had a strong run in housing like we have in the stock market, and some correction was inevitable in the face of the spike in mortgage rates.
Potential home buyers deciding not to pull the trigger and sign a contract now that the average 30-year fixed-rate mortgage is at 4.58%, according to Freddie Mac, up a full percentage point since May.
Potential home buyers saying we've seen some rate increases, we're seeing some more. We want to wait and see if maybe they go down before we sign that contract.
Those higher mortgage rates had the exact opposite effect on existing home sales. In July, they spiked upward by 6.5% to a 4-year high. But that's because home buyers locked in lower mortgage rates ahead of the current upward spiral. Economists say rising rates are a long-term negative for both new and existing home sales.
Generally, the initial phase of rising interest rate brings additional home sales activity, but further increases in interest rates, which we anticipate will begin to diminish the pool of eligible home buyers.
Even with the July setback, new home sales are up 7% over the last 12 months. But builders tell us housing starts on single-family homes in July were the lowest in 8 months. For Nightly Business Report, I'm Hampton Pearson in Washington.
Megan McGrath says this housing slowdown is for real. She's senior housing analyst at MKM Partners and joins us tonight. Megan, thanks for joining us.
Thanks for having me.
One report usually does not make a trend, but this 13% decline's gotten your attention, hasn't it?
It certainly has, and it's something we've been hearing about for a couple of months, and we're finally starting to see it in the numbers a little bit today. And there'll be some numbers next week, pending home sales, which is the apples-to-apples equivalent in the existing market that we saw today. That will be a good litmus test as well. So, yeah, I think that things are starting to slow down in the housing market, and that's natural. I don't think that the housing market is broken. It's still growing. It's just not growing at the breakneck speed it was earlier in the year.
So if you're in the market, whether you're buying or selling a home, what should you do? If you're a buyer, should you lock in a deal right now and not, wait for prices to go down anymore, and vice versa if you're a seller?
Well, I don't think you're going to see the big jump in mortgage rates that we saw earlier in the year. So not another 100 basis point increase that we saw. But I wouldn't expect anything to go down from these levels significantly. So don't wait around and think, well, mortgage rates are going to go down back to where they were, or home prices are going to go down back to where they were. I think they're all going to continue to go up just a little bit more gradually than we've seen. So maybe it gives you time to look at your budget and see what you actually can afford and price in a little bit of appreciation over the next 6 months.
Why don't you think rates go much higher? We're at 4.58% on the 30-year fixed mortgage right now, and that is, as you pointed out, up sharply from where we were a couple months ago, and it was a full 100 basis points below that. The Fed is getting ready to pull back on its quantitative easing. Interest rates have been going up in the Treasury market. So how much higher do you think rates do go?
Well, as we all know, it's hard to predict what the Fed's going to do. And I do think rates are going to go higher over the next couple of years. I think that's a given. All I meant was that you're not going to see the big jump in a short period of time. So there's no reason to really panic here and jump in and buy something you don't want or that you can't afford. You have time to think about it, price in a little bit of an increase over the next 6 months, and think about what is really in your budget.
We saw today home builder stocks, Megan, tumble, all across the board, and yet you still like some of them. You have on your buy list Toll Brothers and KB Home. Why do you like them?
Yeah, so these are the only two home builders we're recommending as a buy right now. And we would say these are a buy if you have a 12-month time frame. And these are two companies that we think over the next 12 months are going to appreciate. They have good stories. Toll Brothers is a luxury builder. Their buyers should not be particularly mortgage rate sensitive, and they're a niche player. So as competition increases in the lower end of the market, which it absolutely will, Toll Brothers will be in a good position. We think their price appreciation and their pricing gains are absolutely sustainable over the next 12 months.
I'm sorry, go ahead.
And I was going to say KB Home, on the other hand, is a different story. They're a turnaround story. They're just getting back to profitability. They're going to have to show us they can continue to do it. But the stock is relatively inexpensive compared to its peers, so we think the risk-reward there is pretty compelling.
Very quickly, I was going to ask, this slowdown, is this prolonged? Is this brief? Do we see higher prices down the road? What do you think?
I think that I wouldn't be surprised to see a little acceleration next quarter. But what I think is that we're probably going from what we saw early in the year, which was 25 to 35% growth on a year-over-year basis. We're probably slowing down. We're probably going to end up sort of 15% through the end of the year.
Megan McGrath, home builder analyst at MKM Partners. Again, thanks for joining us tonight.
Thank you.
That housing news and what it means for the U.S. economic recovery was one of the hot topics today at the Jackson Hole Conference in Wyoming. And that's where central bankers from around the world are meeting to talk about economic policy. Steve Liesman spent the day speaking with them and reports there is still much disagreement on when the Federal Reserve will make a change in its massive stimulus program.
Good evening. A lot of differing opinions here in Jackson Hole at the Fed's annual economic symposium over the direction for the central bank and the next moves for the Federal Reserve. Some of those differing opinions came in interviews I conducted today with 3 Federal Reserve presidents. Now, 2 of them, Dennis Lockhart from Atlanta and John Williams from San Francisco, had pretty much the same opinion, suggesting that it's full steam ahead for the Fed to reduce the amount of stimulus in the economy, perhaps at the meeting as soon as next month.
The way I'm thinking of it at the moment is I'm actually looking at the data and asking if they deny or in some way undermine the basic outlook that I have in place. And on that basis, then I could get comfortable with a move in September of some kind.
I do think if the data continue to progress as we've seen, then I do agree that we should edge down or taper our purchases later this year.
However, St. Louis Fed President Jim Bullard, he had a different opinion. He's a little more worried about the strength of the economic recovery, not quite so confident in it, and he says the Federal Reserve should take its time.
I don't think we have to be in any hurry in this situation. I mean, inflation's running low. You got kind of mixed data on the economy, so you know, I'd be cautious. You know, I wouldn't want to prejudge the meeting, but I think we want to take our time, assess what's going on, and before we make a move here.
Among the research papers presented here today was one from noted Stanford economist Robert Hall, and he says the biggest danger for the Federal Reserve is to exit too quickly from its stimulative policy. He says there could be political forces for the Fed to raise interest rates sooner than it should or to reduce the size of its balance sheet. Also, Christine Lagarde, the IMF managing director, addressed the group at a luncheon, and she said the exit from these unconventional monetary policies, it could get messy, and she urged central banks to work together. And she even suggested that some countries that are affected by tighter monetary policy, they could use some currency intervention. That's a strange thing to come from the IMF managing director. She urged countries to wait until the recovery was firmly in place and to use the time period created by the quantitative easing to reform the financial and economic systems. Finally, a lot of debate over how effective quantitative easing is and how it works, but no consensus has emerged, and maybe that'll happen in sessions tomorrow. For Nightly Business Report, Steve Liesman.
Steve Liesman in lovely Jackson Hole, Wyoming. Still ahead, one day after the NASDAQ halted all trading for more than 3 hours, the CEO speaks out finally. But did he say anything to restore investor faith in the system? First, a look at how the international markets closed today.
No problems today at the NASDAQ exchange following Thursday's massive computer glitch that knocked out all trading for 3 hours. But a lot of questions remain about what really went wrong and why officials were so slow to inform investors and traders about the outage. As Mary Thompson reports, the NASDAQ's challenge now is to restore investor confidence in electronic trading.
When technical troubles halted trading in NASDAQ stocks Thursday, CEO Bob Greifeld focused on fixing the problem, coordinating a reopen with other exchanges, and talking with regulators and head traders, not to the press.
We took the proper amount of time right, to make sure that the testing was done, that the communication yesterday was so strong, and we got that communication done, and we came back successfully. So it's not our job, nor will it be, for us to go on the press, to the press, to public, while we're focused on the issue.
The lack of communication perplexing to retail investor Scott Himmelstein.
It troubles me a lot more than the glitch itself.
And infuriating to trader David Seaberg.
I think it's absolutely irresponsible for them not to make the middle America investor aware of what was happening. The professionals were aware. They were getting feeds. We were getting news feeds coming in. They were making sure that we were aware from the standpoint of how stocks may or may not open. But I can tell you, if you're sitting in middle America, you had no idea.
For 5 hours Thursday, the NASDAQ kept the press and the investing public in the dark about the source of the glitch, the latest to hit the U.S. markets and shake investor confidence.
I think it actually hurts the people that are trying to get ahead, trying to put back money and invest in stocks to save, for their kids' college funds and, save for their retirements.
Crisis management consultant Eric Desenhall notes it also hurts the NASDAQ's brand. In an email, he wrote, "We sleep at night because of the assumption that they know what they're doing. This incident tells us that they don't. Assurances will need to be given, and they'll have to be based on something other than trust us." For Greifeld, Thursday's trouble is the NASDAQ's second high-profile problem in a year and a half. A new computer system botching Facebook's IPO last May, resulting in a $10 million fine for the NASDAQ. And while some may criticize how Greifeld handled the halt, investor Musrar Fatani says slowdowns, shutdowns, and halts are all part of living in the digital age.
I think we're in such a fast, technologically paced, world. I think if we have a glitch like that, that wouldn't make me lose confidence in the whole system.
For Nightly Business Report, I'm Mary Thompson in New York.
Meantime, 2 other stock exchanges are now in talks to merge. This is a deal that would create the nation's second largest market operator. The electronic BATS Global Markets is in advanced discussions with rival stock exchange Direct Edge Holdings. A merger would unite 2 companies that were created by trading firms and banks to challenge the more dominant New York Stock Exchange as well as the NASDAQ.
Both of those exchanges currently looking to merge were set up to accommodate high-speed computer trading, something government regulators are now looking to rein in. The Commodity Futures Trading Commission is close to developing a set of rules aimed at taming high-speed trades like the ones that led to the so-called flash crash at the New York Stock Exchange in 2010 and may have contributed to yesterday's shutdown at the NASDAQ. Turning now to our market focus, we begin with a look at Pandora and its dramatic sell-off. The internet radio service company said late yesterday that the rising cost of acquiring music and expanding its sales force would pull down fiscal 2014 earnings below expectations. It's also facing rising competition from firms like Spotify. Still, none of that worries Pandora's chief financial officer.
We are the undisputed leader in internet radio. We've had competitors large and small over the 9 years we've been establishing this category, and we believe that we'll be able to maintain market leadership for some time.
Investors didn't share that confidence. The stock tumbled almost 13% to $18.91 after more than doubling this year. 2 rivals are teaming up. Expedia and Travelocity are entering a long-term agreement under which Expedia will handle most of Travelocity's operations, including processing bookings and handling customer service. In turn, Travelocity will focus on marketing and promotions. Shares of Expedia soared 5% to $48.84. No trades on Velocity. It's a private company.
Elsewhere, Hibbett Sports is joining a growing number of retailers who are complaining about weak consumer spending. Now, the sporting goods company slashed its full-year earnings as a result, forecasts citing economic uncertainty. Hibbett operates predominantly in the South, the Southwest, and Midwest regions. Shares declined by more than 8% today to close at $53.40. And despite reporting a jump in second quarter profit, Foot Locker is also calling the sales environment challenging right now. The athletic apparel retailer says full-year same-store sales could come in at the low end of current forecasts. That stock dropped almost 3%. It closed at $33.01. And Taylor seems to be the retail standout right now. It's one of the few stores to post an increase in same-store sales figures and report a higher-than-expected rise in second quarter profit. The company's CEO describes business in August as strong. That, along with a buyback, pushed shares up 5% today to close at $34.31.
And coming up on the program, don't be afraid of investing in bonds. Not all of them are so bad. That's what our Market Monitor guest says, and he has one fund to recommend. But before all that, here's a check on how commodities, treasuries, and currencies performed today. If you own a 2012 model of Jeep Grand Cherokee, listen up. Federal regulators are investigating complaints that sun visors in those models can catch fire. 3 owners reported smelling a burning odor, then seeing smoke, and finally flames coming from visors while the vehicles were being driven. It's now up to the National Highway Traffic Safety Administration to decide whether or not to issue a formal recall.
Well, 2 billionaire brothers have recalled their pursuit of the Tribune Company's newspaper unit after assessing the value of the 8 daily papers up for sale, including the Los Angeles Times and the Baltimore Sun. Charles and David Koch decided the deal was not worth it. Tribune emerged from bankruptcy protection last year.
Our Market Monitor is a long-term bull on stocks, but he expects a 5% pullback between now and the end of the year. He's Chris Orndorff, Senior Portfolio Manager at Western Asset Management. Chris, welcome back to Nightly Business Report. Let me talk a little bit first about your market outlook before we get to specific stocks. We're hearing from a number of money managers that there's going to be a correction, a pullback of different sizes over the next couple of months. Is this time for investors to load up a little bit more on cash and pull back from stocks?
I think so, and the primary reason is valuation. The P/E ratio for the S&P 500 is above 15, which is among the highest among global stock markets in the world. And clearly, typically when you see these kinds of P expansion, Ps were lower a few years ago, it's typically an environment of falling bond yields. But what we've been seeing is indeed rising bond yields over the last year, and the increasing attractiveness of bonds is putting some pressure on stocks.
That is for sure right now. Chris, we have some viewer questions for you on individual securities. Linda H. would like to get your thoughts on British Petroleum. What do you think of BP right now?
BP pays a nice 5.3% dividend yield, but earnings growth and cash flow have been a little bit below expectations, and we've got the second phase of the Macondo oil well trial beginning at the end of September. So I think if you can deal with the share price volatility, its income's attractive. I like the stock.
Tell us about iRobot. Jen L. is interested in it. What do you think? Buy, sell, or hold?
Well, this company makes small robots that mop and vacuum, among other things. It's a nice product. I really like it. Earnings are growing nicely. They've got a large patent portfolio, which should be valuable years down the road. But the valuation is really expensive, and I would look for a better entry point, I think, on this stock.
Okay. We heard from Edward L. in Los Altos, California. He owns several real estate investment trusts, probably for income. Wants to know if he should hang on to them or run for the hills, as he put it.
Well, I think REITs, it's a very broad category, but I think REITs are a great part of a portfolio for income-oriented investors. My favorites are office REITs, which hold Class A office space in major U.S. cities, as well as mortgage REITs, which have private residential mortgages. They pay very high dividend yields, particularly the mortgage REITs, but the share prices are volatile. So investors need to have a long-term time horizon and be well diversified.
Let's turn to one of your own recommendations. Tell us about Western Asset High Yield Defined Opportunity Fund. That's a mouthful. Why are you recommending this one?
This is a closed-end fund that pays a 9% dividend yield, and it trades at a discount to its net asset value. And with the increase in bond yields, bonds have been sort of thrown by the wayside by a lot of investors. And this fund now has a low share price and is a particularly attractive entry point, I think, for patient, income-oriented investors.
Do you look overseas at all? You can get a pretty good dividend yield elsewhere. Some of the bonds overseas are paying a pretty good income as well. Do you look there, or do you just stay in the United States?
Oh, no, Western Asset's very much a global firm, and there are some outstanding opportunities overseas, particularly in emerging market corporate bonds that trade in U.S. dollars, so there's no currency exposure, but very high credit quality and very attractive yields.
All right, so, just to wrap it up here, for investors who are, this is a really inflection point in the markets in terms of what they should be doing with their portfolios. Any changes, fundamental changes that they should be making right now?
I think they should stick with the income focus. If they need to load up on income, this is probably a pretty good time to do so. And again, as long as they have a longer-term time horizon and they keep a well-diversified portfolio, they're going to be fine. The market's always going to have ebbs and flows. We've seen it in the past. We're going to see it probably in the next 6 months with a lot of events going on in the government and the Fed changeover and everything, all the things you've described on the program. But income is a very important part to everyone's portfolio.
All right, lots of good advice. Thank you so much, Chris. Have a great weekend.
Thanks, Bill. Thanks, Susie. You too.
Chris Orndorff, Senior Portfolio Manager at Western Asset Management.
All right, finally tonight, something I'm familiar with. The company that makes Jack Daniel's whiskey is having a hard time keeping up with customer demand. So Brown-Forman is building a brand new $100 million distillery at its Lynchburg, Tennessee factory, looking to increase production of its best-selling whiskey by as much as 20%. Get this, it's the first time since Prohibition that the liquor giant has built a new distillery from scratch.
And
That's
I wonder why
that.
Yeah, I wonder why that is.
Well, it goes in trends, but right now, distilled spirits are very hot in the market.
We're going to wrap up now, and we can go and have a drink.
What a good idea.
That's Nightly Business Report for tonight. I'm Susie Garob. Have a great weekend, everyone. You too, Bill.
Thank you, Susie. You too. I'm Bill Griffith. Thanks for watching. We'll see you on Monday.
Nightly Business Report has been brought to you by sailing through the heart of historic cities and landscapes on a river. You get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
I'm Susie Garob with a Nightly Business Report news brief. A shocker today from Microsoft. Steve Ballmer is stepping down as CEO over the next year, and there's no obvious successor to take over the top spot. Microsoft was the Dow's biggest gainer today, soaring almost 8%, while the Nasdaq got a lift from shares of Facebook, which closed above $40 apiece for the first time ever. The Dow rose 46 points, settling back above the 15,000 mark. The Nasdaq added 19, and the S&P was up 6 points. Investors bought up stocks despite disappointing news that new home sales plunged more than 13% in July, hurt by rising mortgage rates. And the billionaire Koch brothers decided not to pursue buying the Tribune Company's newspaper group, which includes the Los Angeles Times. Be sure to tune into Nightly Business Report right here on your public television station.